Hi everybody, welcome to our DAT IQ Weekly Market Update. Today is March the 18th, it's episode 331. I'm Dean Croak, market analyst here at DAT, along with Rick LaGore from Intech Logistics, special guest today. Rick, great to be with you finally.
Hey, great to join in.
Yeah, I've wanted to have you on our show for a long time. I'm a big admirer. You've got a great website. I'm always fascinated with your website, especially the resources section.
Thank you. We put a lot of effort into it, do a lot of writing. We really pay attention, try to pay close attention to the market,
Yeah.
and really focus in on domestic intermodal.
Yeah, it's a wonderful website. I was showing it to my wife this morning. She's looking at rejigging her catering website, and I said, "This is a really good website design here. You should take a look at this."
Hey, thanks.
Rick, for those new to the show that haven't met you before, tell us a little bit about what Intech does.
Yeah, so Intech Logistics, we've been around really since 2003. In 2007, we made a strategic change or strategic direction, and we went from being a basically regional brokerage in terms of supporting a warehouse or several warehouses in the Midwest to flipping over to domestic intermodal. So we are moving freight throughout North America, so Canada, Mexico, cross-border as well. Our major competition is, of course, J.B. Hunt, Hub Group Mode. So while essentially five players occupy, let's call about 85% of the space, the other 15% is occupied by a bunch of what I would call ankle biters like ourselves. And so we try where we fit in is we fit in terms of driving a higher level of service than what you typically would get from one of the larger intermodal providers. Although I will say JB Hunt is one hell of an intermodal provider there in the U.S. We compete against them, and a lot of times we are in the same docks as JB Hunt. It just happens to be that we may have the customer that we're dealing with may have some higher level of service requirements going in and out of their docks for some customer lanes.
Gotcha. All right, well, we'll bring you back a little bit later. I'll dive into the market update now, and then we'll come back and have a talk about the intermodal and railroad business at the back end. All right, some of the key trends we're watching: spot rates down in dry van and reefer. Flatbed continues to improve, up 11 cents a mile year over year. Although Ratecast is starting to show some weakness out into mid-April, where flatbed rates ex-fuel are looking to flatten out a little bit earlier than expected. Normally they have some pretty good strength all the way through to mid-July. Jason Miller's Michigan State University Truckload Ton Mile Index out last week for January. Remember, this is on a 45-day lag, but it's based on 41 freight generating commodities that's specific to the truckload sector. Demand was down in January, most likely due to extreme cold weather, according to Jason, down 0.4% month over month, flat year over year, sitting about 3% higher than January 2018 and identical to where 2019 was, and about 1% lower than January in 2020, right before the pandemic hit. Cross-border volumes out of Canada continue to plunge, especially outbound Toronto. Spot market capacity remains very tight on some lanes, Indianapolis, Joliet, and Chicago, some of those lanes that are very tight. But volumes are readjusting back to below long-term normal averages. Toronto outbound 250 to 750 mile range last week, which picks up a lot of the cross-border volume into the Great Lakes and Ohio River Valley, are exactly half of what we typically see between Monday and Friday each week over the last 7 years. So volumes have dropped to about half of what we normally see coming out of our biggest market in Canada, outbound Toronto. Diesel prices, one of the things we're watching carefully, they're down 11 cents in the last 2 weeks, according to John Kingston at FreightWaves, lowest in a year. But there's some warning signs that he raised that I think we all need to pay attention to in terms of diesel prices. There's some potential for refiners on the Gulf Coast and retaliatory tariffs that could impact capacity losses and higher prices. The US refining industry relies heavily on exports, particularly along the Gulf Coast. With diesel at 33% of operating costs, or 55 cents a mile, it's one of those variable costs that have shown to have the greatest impact on small carrier profitability in the last couple of years. So any upside pricing risk is something we need to watch very closely. This week's market update, that'll be out this evening at dat.com/market update. We're having a look at the February import numbers out last week, the Mid-America Truck Show next week, and the Logistics Managers Index from Zach Rogers. for February. All right, let's dive into the load to truck ratio for dry van. Volumes are down for the third week. Compared to week 11 last year, volumes are about 6% higher, even though they were down last week 2%. Load to truck ratio ended the week at 4.89. Refrigerated market volumes decreasing again along seasonal trend lines. Last week's load to truck ratio was 6.41. In flatbed, volumes have been increasing for the 8th week, following last week's 7% week over week gain. Flatbed volumes are about 34% higher than last year, but about 5% lower than the long-term average for week 11, excluding the pandemic impacted years. Load to truck ratio ended the week at 41.12. A bit of a detailed look at some of our rates in the line haul side of the market. These are dry van line haul rates excluding fuel. Rates down 2 cents a mile last week. National 7-day rolling average was $1.64 on a 1% higher volume of loads moved. At $1.64, rates are about 6 cents a mile higher than last year and about 4 cents a mile higher than where they were in 2019. In our Midwest region, bellwether states, which have the highest correlation to the national average, volumes were down 1% last week, spot rates down 4 cents a mile, but paying $1.89, that's about 25 cents a mile higher than the 7-day rolling average. On the northern border, volumes have crashed outbound, as we covered there. Toronto to Canada, Toronto to Chicago, rates are way down. We're seeing rates down about 20 cents a mile below the long-term average regional line haul rate. So we're waiting for those volumes to continue falling. Hopefully they've stabilized and might bounce back. But I think with some of the ongoing uncertainty, some of these volumes are looking like they're becoming more permanent than transitory. In the refrigerated market, line haul rates are down 2 cents a mile last week. Also, paying carriers an average of $1.89. Volumes were down 3%. So that's loads moved, not loads posted, 3% lower. After being higher than last year since the end of January, reefer spot rates are now 1 cent per mile lower than last year and also identical to where they were in 2019. In the flatbed market, the national 7-day rolling average has increased for the 5th week. Following another 2 cent per mile gain. At 209, flatbed rates are 11 cents a mile, or about 6% higher than last year, and very close to where they were in 2018-19, in fact straddling almost between the two. Let's have a look at our short-term forecasts. These are our Ratecast forecasts out 35 days. These are for loads moved over 550 miles, excluding fuel, so they're line haul only. Couple of forecasts there. If you haven't seen them before, the green is the Ratecast forecast. It's bounded by some higher and lower case scenarios in gold and red, and the blue is the historical 7-day rolling average. So Ratecast in the dry van sector is seeing a little bit of deterioration in the rates going out 35 days. It's expecting rates to drop another 15 cents a mile from where they are now to $1.48 per mile out by the 17th of April. Last year at that time, it was $1.55 per mile. So that's 8 cents per mile higher than where Ratecast thinks the rates are going to end this year and where they were in 2019, which of course was a bad year for carriers. So not a really good forecast there, but I have to say, looking at some of the deterioration we're seeing in demand and uncertainty around trade volumes and consumer confidence weakening, Ratecast, I think, is pretty accurately predicting where rates are going to go. In the refrigerated market, Ratecast is expecting rates to drop another 15 cents per mile to $1.74 by the middle of April. This time last year, rates were $1.83, so they're about 9 cents a mile higher than where Ratecast thinks rates are going to land this year. Similar sentiment to dry van. We're starting to see some produce volumes come into the market, but I think consumer demand is going to be the determining factor as we get into early April, when we normally see produce volumes start meaningfully around the Vidalia onion pack date, which is yet to be announced. And in flatbed, Ratecast is thinking rates will be flat out to the middle of April, averaging $2.09. At this time last year, rates were $1.99. So Ratecast is expecting rates this year to be about 10 cents per mile higher than where they were last year, which is good news. So better year-over-year comps in flatbed as it reaches its midpoint through the season. Having a look now at the new rate development for contract rates. Chad's not with us today, so I'll just quickly cover this one slide. But these are the new rates coming into routing guides, excuse me, for contract rates. So remember, contract rates represent about 80% of the volume moved in the freight market in dry van. These rates, on average, are down about 0.3% for all of that's the average of all of the repetitive lanes being used in routing guides. Replacement rates, though, that's the percentage difference between new contract rates based on a recent RFP and the ones they're replacing from a prior RFP, possibly a year earlier. So replacement rates are up about 1.7%. That means that new contract rates entering routing guides are about 1.7% higher than the ones they're replacing. We've been in positive territory for almost a year now after decreasing for almost 3 years, which is the red on the chart. And you can see the blue prior to that during the pandemic. Rates had increased for about 2 years from June 20 to June 22. But the interesting thing about the chart, I think, is that we're not seeing any steep upward inflection in new contract rates. It's sort of jumping up and down between 2 and -2% over the course of time. We're not seeing a lot of significant upward movement in contract rates yet, although most of the new contract rates haven't fully entered routing guides based on last quarter's bid season. All right, let's dive into the question of the week. Bring Rick back in. Rick, what trends are you seeing in the intermodal market?
So on the intermodal market, starting to see volumes decrease. They're coming down a little bit. We were really expecting to see those come back up again. When we were looking at the end of the fourth quarter, volumes were showing some steady underlying demand was increasing. But since really Chinese New Year's hit, we have continued to see those volumes decrease. And with Chinese New Year hitting a couple of months or a couple weeks differential than prior year. We were really expecting, the last part of February, early part of March really start to kick up again because of the differential in Chinese New Year that never hit. On the rate side, we are seeing, at least on the spot rate, so I don't know, well, I know you're aware, but I don't know if everyone else is aware, but we track intermodal on the spot rate side, and we've been tracking it since 2010. And on the spot rate market side, we've seen a decrease that occur ever since the beginning of January. And it actually looks like it's going to be continuing a decrease, and we're projecting that it's going to go back down to the lows of last year, which was May. We have just not seen a strength in the market at this point. And one of the reasons we track what goes on in the domestic intermodal side is because it's so closely correlated with the truckload. And since tracking this since 2010, there's not been a single moment where that truckload takes off and intermodal doesn't follow. So when we were hearing that the truckload market was starting to take off, or at least there's some hope of it taking off at the beginning of the year, and that was still being talked about through the end of January, we were saying we don't see that on intermodal. And as a matter of fact, we're seeing the rates start to come down in intermodal. So what we were saying is people are really squinting to see a better year, or at least a better first half and an overall better year. So right now, from our perspective, we're feeling, well, at the end of last year, we were thinking that we were going to hit the cycle in the June time period where we're going to start to see volumes really start to move upwards and see some strength in the pricing. It appears that we're going to miss that period, and the next logical place at this point that we would feel that a recovery is going to hit would be in retail season, so late third quarter, early fourth quarter, and we're in hopes that happens. Although there's just so much, let's call it disarray that's going on.
Yep.
A lot of people are really trying to figure out what they need to be doing, what their supply chains look like, what demand is going to look like, and so if we happen to miss the late third quarter, early fourth quarter, we're saying that the next cycle we're going to have to hit it. We're going to have to wait until May, June next year.
Very interesting. I read with much interest your January 5 article where you talked about your intermodal index. And I was fascinated. I never really thought this through, where you said that intermodal plays a critical role because it offers shippers an essential outlet for additional 53-foot capacity when truckload capacity is tight.
Yes.
But I think your article said, you said that when intermodal rates begin to rise meaningfully alongside truckload, then we know that we've got a market inflection.
Absolutely.
But we're not seeing that yet. You're right. I think early January is a bit of a head fake, right? Where we saw cold weather drive up.
I think it was a combination of pull forward of tariffs, pull forward to avoid the East Coast strike, which never happened, thankfully. And yeah, there's a little bit of the weather that played in, but I think the first two were at least from our customers' perspective, were more the issue.
Yeah. Yeah, we've seen rates return to their normal seasonal trend lines on the way down. I don't know if you follow Bill Cassidy's Journal of Commerce Truckload Capacity Index, but he used a couple of words that really described, I think, where truckload capacity is at. For about 7 quarters, large fleets were slashing their truck counts, but in the last 2 quarters, they're trimming. So it went from slashing to trimming, but the point was they're still reducing their truck counts.
Yes.
And when you relay his index, or when you overlay his index with contract rate and new rates coming into routing guides, you see a very strong correlation where shippers have had pricing power for the last year. And it's only on some lanes where bids are coming in higher, but it's probably a 50-50 split between the two. So we're sort of still at this point in both the spot and the contract market where we're still searching for equilibrium. We're not there yet. And I think that the bigger concern that we've got in truckload, and I'm sure intermodal carriers do, is that we're trying to rebalance our supply levels, but against the demand target that seems to be disappearing out into the horizon. That's the problem that we've got.
Absolutely. So the demand target looked much better at the end of fourth quarter for a great period over the freight recession. A number of the boxes that the asset intermodal providers had were being parked and stacked across the U.S. Fourth quarter, we started to see that those boxes were being released, and we were hopes again that all the boxes were going to be released, but the demand isn't there for all of that. So we still have boxes stacked, and we'll see whether or not it returns to stacking, or we see a general flow or demand that requires more supply to come back to the market.
I went to Australia in January, and I had the opportunity to call in to have a look at the Tehachapi Cut, and I was just fascinated by that particular piece of geography. But what struck me was there's like about 35 trains a day go through there bidirectionally, but the number of long trains, double stack empty containers, where some of your competitors were moving towards California was striking, as they tried to get those assets there to catch that volume coming in from Asia.
Absolutely. But again, things have slowed up, and the outbound rates out of LA at this point have definitely started to decrease, which has a meaningful drawdown on our overall index.
Yeah, we've seen, we look at the IHS Market Peers database for import volumes. They came in at the highest level that we've ever seen in the month of February. But they've been like that for September, October, November, December, sort of very high levels of monthly import volumes. What do you think that means for, and I'll restate it, we normally see February's the low point in the shipping year, but it's the high point this year. Do you just see that the peak season will be relatively flat in Q3 and Q4? Is that what that means?
Yes, even if we had a good volume season, typically the first year out of a freight recession or let's call lack of demand. I should get away from freight recession. We've really tried to get away from it here at Intech and really say this is really things were crazy during the pandemic. So we're going to have a downside after that.
Sure.
So anyway, we've tried to get away from using that word, yet I've continued to use it here with our call right here. So I'll try to back off of that. But typically, when freight rebounds, the first year is usually it's muted, and it's usually the second year of a recovery that we actually see peak volumes and really those surcharges that are put on boxes moving from west to east, primarily out of Southern Cal, Northern Cal. So at this point, we don't really see that occurring this year. Again, we may have some tight markets at various, week here, 2 weeks here, but nothing that's going to be severe in nature.
Yeah. On the role of IMCs, so a lot of people don't realize that, you don't buy directly from the railroads when it comes to capacity. Can you talk a little bit about your role in the market and how you access those rates?
So there's really a couple different kinds of providers. So most people are fully aware of the IMCs, the bimodals, which would be the folks that have assets, both boxes, and also they support their dray with their own company drivers and equipment. Then there's companies like ourselves who access the market and grain capacity for our shippers. We have our own ramp-to-ramp rates with the railroads. we utilize both the railroads boxes. There's also private boxes that are out there that we can obtain from various other companies that have just boxes. And then we have our own dray capacity for the origin and the destination. In some cases, we actually purchase from the railroads a door-to-door service. In some cases, that's actually more beneficial for our customers in terms of capacity and service levels. But it really depends on the lane, whether it makes more sense to go ramp to ramp with our capacity with the railroads or the full door-to-door service. Now, there's another piece that we also provide, which is the steamship lines. They bring boxes in to the States, and they bring them in fully loaded. They get into the interior part of the U.S., and then in most cases, those boxes are having to go back to the West Coast or back to the East Coast empty because there's not enough product to put in them to go back. So they call it the repo market, which really doesn't sound so great, but it's really repositioning market. What we end up doing is we take those 40s, and it really works really great for heavier product where it tends to weigh out before it cubes out. So beverages is one of the bigger plays for us in that market. But we'll take the 40s, we'll load it with beverages, and then we'll take it to the East Coast. And there's an incentive for shippers to follow that direction because typically, again, the steamship lines don't have paying freight in them. And so if they have some paying freight in them, I mean, there's drastically reduced prices that we can offer shippers to go ahead and move those boxes back to the coast, which then once they get to the coast, unload at their particular customers, and then they go off empty overseas. So so there's a few different ways that we can access the capacity.
On a typical stack train, for example, what percentage of the slots would be spot versus contract?
Closer to 95%, probably more like 95% plus or minus a couple percent. Intermodal is really more of a contract play than it is a spot play.
Right.
So that's why a lot of people ask us, why the heck do you even track the spot rate? But it gives us insight as to what's going on in the market, and it gives us insight as to what's going on in the overall 53-foot market. Yeah,
especially with your index and its relationship to truckload rates.
Yes.
So how often or how long in advance do you have to secure a spot or a slot on a train for a spot market move?
There's opportunity. It depends on the particular ramp, but most of the time we can secure them same day. Well, as long as it's morning is the same day. We prefer to have 24 to 48 hours for the best service and also to give the customers the best flexibility that they have on their docks. But it depends on the market, really.
Right. Let's talk a little bit about the role between intermodal and truckload. Both move typically domestic intermodal move in 53-foot loads. So how do the two work together? Because I often hear large railroads talking about wanting to be truckload-like on shorter lanes, but they own the longer haul sector of the market completely. How do you see the two interacting? And is there any chance that railroads could make a viable play against the truckload market in, say, that less than 1,000-mile haul?
We really see right around 700 miles makes the most sense to really start to look at whether or not intermodal is going to make the most sense.
Right.
As the line haul portion or the rail portion extends beyond that, you can get further and further outside of your ramps for your origin and your destination. We really like to see on a 700-mile type run, somewhere around 50 to 75 miles on the origin and the same on the destination dray. But again, once you get those miles going further and further out, you can go ahead and as you take advantage of the rail efficiencies and pricing, you can go further out on your dray capacity. In terms of trying to tighten those up, there are some markets that make sense even at the 400 to 500 mile radius. Again, those would require closer ramp commitments or closer ramps to the origin destination that shippers need. And also there's some interesting combinations that continue to play out where the class ones will work with the smaller railroads or the more regional based railroads that have some opportunities as well to go ahead and take advantage of those shorter runs. But primarily the intermodal traffic is on the class ones that go throughout the U.S.
So just to be clear, you're saying that truckload is more competitive on less than 700 miles, but within a sort of an hour's drive of the ramp?
Yes, yes. I mean, again, between 500 to 700,
Right.
it's like 50-50. It really depends on that combination of origin, destination, ramps. But yeah, that's what I'm saying.
Yeah.
But yeah, clearly the long haul, that's where it makes a lot of sense
Yeah.
to be using intermodal. And one of the misconceptions is on intermodal is, well, it's really slow. It really isn't. It's what we tell our customers, and what we end up delivering is we tell them that it's truck transit plus a day. That changes if you're going to go ahead and interline between one railroad and another railroad. You typically pick up another couple, 3 days, sometimes more, depending on the combination.
Right.
But most of those interchanges occur up in the Chicago area as we're going east to west or west to east.
So truck plus 1 day. That's interesting.
Truck plus 1 day. It's much different than what you see in people that deal with rail cars, which is a longer transit on the repositioning market. There is a longer transit typically as well on those as well. They run on different trains typically.
Yeah. Do you see any change in the balance of freight, East Coast versus West Coast, and the talks of maybe some trade challenges that they're going to face through the Panama Canal? Red Sea crisis has kind of bubbled up again now that we've launched an attack on the Houthi rebels. Do you kind of see, because we've seen volumes move back to the West Coast, and maybe lower inland pricing moves on the intermodal side has facilitated that. What's your sense of the balance between the two? Is there anything that's going to change on the horizon?
With intermodal being a long haul play, predominantly, you're going to find that the West Coast is going to be much more a play for intermodal than you're going to find on the East Coast.
Right.
So in terms of doing what makes the most sense, you should really be looking at intermodal if you're moving in through the West Coast. We've seen the balance go back as well to move back to the West Coast. Although during the pandemic, we did see a number of people start to balance a little bit. It's kind of crazy to be all one port related. And so we've seen people put eggs in a few more baskets, which makes a heck of a lot more sense to balance that trade against the East and West, and even coming across on the southern coast of the U.S.
Yeah, we've on the truckload side, we see a direct correlation between import surges in Los Angeles and Long Beach and truckload spot market plays. But over the course of time, those rates have dropped right away to where Nagari Ash's intermodal index has them spot plays on the spot side. Shippers save about 23% on spot moves, and they save about 26%, I think, on average over the course of last year on contract moves. So pricing still favors the intermodal move substantially from a shipper's perspective.
And there's another play out there in the West Coast. So on the West Coast, there's a lot of transloading. About 35% of it is transloaded at this point. That number changes all the time, but we just kind of go with the average of 35%.
Right.
And so there's also some savings there, because every third or fourth, depending on how that plays out and how that freight is loaded in the container, is essentially free, going from a 40 to 53.
So is most of the transloading then for an intermodal move once it's unloaded and reloaded?
Typically, yes, but your IMCs will also offer to the shipper community their truckload capacity as well.
Right.
So if they have some freight that they need to go ahead and get in a more expedited position in the U.S., we absolutely will transload and put them on a truckload if they need it.
Yeah, but the majority would be going on rail.
The majority goes on rail, absolutely.
Okay, yeah. I heard from the head of the Long Beach port that, and I don't know if this figure is accurate, but they said about 70% of all containers that come in end up east of the Mississippi. Would that be close to accurate?
We've heard the same numbers. From our perspective, yes. From what we see, yes, we see that occur, where the majority of it will go east of the Mississippi, absolutely.
Yeah, it's a fascinating country. And then we could get into this discussion about Chicago and all the rubber tire moves across town.
Rubber tires, steel wheel too, steel wheel as well. So yes, Chicago is the largest inland port that we have in the U.S.
Yeah, it's fascinating. All right, we're up on time. I'd like to bring you back maybe in a few months, maybe mid-year, and see how things are panning out. I think
that would be great. Hopefully, we'll have a more positive outlook than what I shared today.
Yeah, I hope so. I think
yes, me too. But it also means great stuff for the truckload as well.
Yeah. We'll see if both indexes are moving in the right direction. But Rick, for those who want to contact you, how do they do that after the show?
A couple ways you can get us. You can go into our website, which we talked about a little bit earlier, which would be intechlogistics.com. You can also see us on, find us on LinkedIn. You can find me on LinkedIn. I'm very active on LinkedIn.
Yep.
We also have Twitter and a couple other, I should be calling it X, and Facebook as well. You can find us on. We'd be more than happy to answer any questions. And if you'd like interested in podcasts, we get a podcast out about every week and a half. So you can find us on all the podcasts, whether that's Spotify or Apple or wherever you listen or see your podcasts.
Fantastic. All right. A couple of other shout outs. Freightvine podcast. We've got Bobby Holland from US Bank. Next week's show, David Hoffman, supply chain experts on the show. Don't forget International Road Check Week is May 13 to 15. But as always, I'm sure the inspectors will be out the week prior. Mid-America Truck Show is next week, starts next Thursday. I think it's the 27th. DAT will have a booth, 37415 in the South Wing. I'll have my Peterbilt there. I'll be outside in the show truck area if you want to swing by and say hello. Make sure you set up alerts for our live show, subscribe to our channel. With that, another show is in the books. Thanks, Rick, for joining us. Thanks for watching, everyone. Be safe, be nice to everyone. We'll see you again here next week at 10 a.m. Eastern, 7 a.m. Pacific.